So this video is actually part of a longer video that I recorded. If you want to see the full video, check the video description, or I will have different chunks as well. So if you want to check out the different topics that I cover inside of this video, I do go into an in-depth reasoning as to why I'm putting so much money into Index Universal Life. So check the video description if you want to see the whole video. All right, so now getting into my own policy. In this case, I am a male, put this in force as a 35-year-old, and my health rating is preferred plus non-tobacco. So that's the highest top rating that you can get, and it's not like I have no problems. I was in the Army Infantry, and I have VA health rating. So it's not like I'm untouchable. A lot of people can qualify for a good health rating. There's different conditions that might hurt your health rating a little bit, but really this can be an effective strategy for people who can get anything above like a standard health rating. And so in my case, I have $1.1 million of life insurance, and I'm putting in around $70,000 per year into this policy. And what this illustration is going to do is going to assume a 6.19% crediting rate. Like I said, I think we can do better. I think we're going to probably see 8 to 10% over the life of this policy. But illustrating conservatively is good. I think so you can expect higher stuff, or you can hope for better. But I think this is a really, really safe assumption in terms of what you can see over the long term. And here I've got $7.4 million in death benefit at age 70, $39 million at age 100. And cash value at age 70 is 6.3 million here. So that's all the stuff that I have going on with this policy. So let's jump into the values here. So again, none of this is guaranteed, but this is what I think is a reasonable conservative estimate of what we can expect in this policy. So I want to explain some of what's going on here, because there's a lot that I didn't understand when looking at an illustration that didn't make any sense to me. And there's actually some things here that sort of discredit the way that Dave Ramsey says you don't get access to your cash value, you only have your death benefit. Well, in this case, I'm paying for $1.1 million in life insurance. We can see that here, $1.1 million in life insurance. But in year one, end of year one, I have 1.1665, significantly higher than 1.1 million, because that's actually just a product of this accumulation value. So that accumulation value is getting tacked onto that $1.1 million of insurance. So my cash value is added to my death benefit that I'm paying for. That's just one point of how Dave Ramsey doesn't understand these life insurance products, or he just is deceptive. I don't know which it is, but not all life insurance will work like this. There are some that are sort of more in line with what Dave Ramsey complains about. But just depending on what you're trying to do, that may or may not be beneficial to you. And so, one of the concepts there is you can have a death benefit that doesn't increase, and what you're doing is you're reducing your net amount at risk, so the amount of insurance that you're actually paying for, and that will reduce the costs that are inside of that policy. So there are circumstances where that might be advantageous. But in my case, for the amount of money that I'm putting in, I have to basically do this increasing death benefit for this carrier and this product. So again, putting around $70K in for the first few years, and this is actually something I probably would have done differently. I designed this policy, or worked with my wife to design this policy in a way that allowed for me to put in a lot of cash early on, because I wanted to put cash from real estate proceeds and a number of different things into an insurance policy. But what I probably would have done differently if I was opening this policy today is I probably would have increased my death benefit in order to get cash in faster, because this is a little bit of weirdness that you see here. So there's a reason why you see this go from 3 years of this $70K and then dropping in year 4 to $18K. Because there's the concept of a MEC limit. So that's what we call it, modified endowment contract. That is, there are rules in place that, make insurance, and we teeter getting up close to that limit, and because we want to use these as a cash growth product. But that's how you get the tax advantage status. That's how death benefit passes income tax free to your beneficiaries. is because it's considered insurance. And so by putting this in there, with the amount of insurance that I had, I was limited in how much I can put in. And so in this case, it's actually $56,165. That's like how much I could put in over the long-term life of this policy, but I wanted to front load funding this heavier. In hindsight, I probably would have gone with a little bit more death benefit if I wanted to fund it at this 70,000 or so, and then later on, if I wanted to, I could reduce that death benefit as needed. But if I was to work with you and you're in this circumstance where you want to get cash in faster, then that's something we can talk about and discuss based on your situation. So with all of that, we're looking at here. The other thing to consider is we've got accumulation value and cash value, and you see, these are two different things. So cash value factors in the surrender charges. For the first 12 years, you'll see that the cash value is less than the accumulation value, and in year 13, you'll see that those amounts are actually equal. So when we look at that, we can see those things are equal in year 13 because there are no longer surrender charges. And so the surrender charges are, the insurance company protecting themselves. They've paid the commission to the agent. They've paid for your medical exam and pulling your records, and they've got staff that they got to pay. So there's a lot of reasons for that. This carrier does 12 years of surrender charges, and that's why those things don't line up. When your interest is credited, it's based on your accumulation value. So, if the market does 10% in year 2, as an example, then my account should get credited with around $13,800 for that year. So your earnings are going to be based off your accumulation value. The other place where these things will not align, so your cash value and your accumulation value, is if you used the indexed loan option. And so if you take an indexed loan, let's say in year 5, I take $100,000 out as an indexed loan, I will pay interest to the insurance company for that $100,000, and this cash value will be reduced to $204,000. But the accumulation value, the amount that is earning interest, is actually going to continue to be here, at that accumulation value. So I'll pay interest on that $100,000. That will reduce my cash value by $100,000, but I will earn interest based on the accumulation value. And that's what really makes this very, very powerful. So you have, and compared to whole life, you have the opportunity for some really, really big arbitrage. And that's sort of the go-between of the interest that you're paying and the interest that you're earning. That's what we're talking about when we say arbitrage. So within an indexed universal life policy, you can have the opportunity to have years where you are paying 5% in interest and earning 10, 12% in your policy on those same funds that are in your policy. So that's what's really powerful about this. And there's not really a comparison of that, other than if you were doing a securities-based lending with your brokerage. But in the case of your brokerage, because you're actually invested in the markets, they will want to keep a margin. Usually it's 30 to 50%. You must have like a really good scenario and a ton of money if they're going to give you like a 50% asset value margin. So if you had $100,000 inside of your brokerage account and you wanted asset-based lending, they might give you the $30,000 as your line of credit with that. And, with that $100,000, you might have a 30% year. So you earn $30,000 in interest, or, in crediting in a sense. But your funds that you had a loan for in 30%, you might pay a couple points of interest. So you're earning money on it. So it's similar, but you run the risk of a margin call. So let's say you have $100,000 in the stock market and you lose 30%. Well, now you have $70K in value in that brokerage account, and your loan out for $30,000 is too high. You don't have enough margin. So you'd have to come out of pocket, either pay off the loan or come out of pocket for $9,000 to continue to have that, because your 30% of $70,000 is like $21,000. So that's another thing to consider. That's why there's not really a parity with all of these things. And so like by year 13, I should have around $1 million in cash value, $2.1 million in death benefit. And it's just going to grow from there. And that's what's really powerful about using an index universal life policy to build wealth. And in turn, I'm using this, if I want to go and buy a property, cash, I can buy property cash, and employ the BRRRR strategy. So I have a video on that on this channel, so you can check out my video on the BRRRR real estate investment strategy, where you reuse your capital over and over again to build out your real estate portfolio. So I can buy properties cash and then eventually cash out, refi, and pay off the loan to the insurance company, and have that as a rental property, earning me cash flow, and at the same time I'm earning interest here. So this is how you can really just kind of accelerate your wealth growth by using these types of things. So I want to make sure I cover one of these, the negative points of really any life insurance product for cash value growth. And so what you'll see here in these early years is that we have $70,000 a year or so going into this policy, and it isn't until year 3 that we're pretty close to breaking even based on this illustration of 6.19% returns. So we might do better than that, but like even in the illustration and in any life insurance that's out there, you're not going to see a break even for at least a few years, and that's what I call the capitalization period. So you have to capitalize your policy in order for it to get the growth and overcome the expenses that are in the insurance. So in year 4, this shows it's definitely breaking even, because 18,600 something plus 210,000 from the 3 years of this. It's showing a break even in year 4 on the cash value. Again, accumulation value is what your crediting is based off of, but in terms of what you have access to or what you could walk away with in this policy, it takes about 4 years for this policy to break even. So, and that's going to depend on how quickly that is will be affected by your health rating and how much money you're putting in with respect to sort of what your MEC limit is, your modified endowment contract limit. So it's going to vary, and also in this case in an IUL, it's going to depend on what the market does. So you could see better. You might see a year or 2 break even if the market has some crazy years. But it's I want to make sure that we cover all of the negatives along with the positives in this using this strategy. So this was recorded as part of a much larger video that breaks down my IUL, my Index Universal Life policy, and how Index Universal Life works in general. So if you want to see that, check the video description. I'll also probably put links somewhere up here for the playlist that has the smaller chunks of the video, like this one. And we'd really like to work with you. If we can find a way to help you, we'd love to. So book a meeting with us. You don't have to have nearly as much money going into this as we're walking through here. You can get started with a few $1,000s a year. And a good starting point is probably moving aspects of your emergency fund into this, because you can still access these funds within a couple of days by taking policy loans. So again, check the video description below. If you want to book a meeting with me, drop a like, subscribe, comment. Thanks for watching.